Hey traders, Todd Gordon here with TradingAnalysis.com. This is CNBC's Trading Nation. Traders, it's time to go short the SPY. Now, I'm not calling a top, saying the market's going to crash or really significantly sell off. I have a way to give you context as to how far the market should fall according to the model that I follow. And before we jump into the SPY chart here, let me show you the model that I am referring to, which is the Elliot wave theory. This gives me context in terms of how far progressed we are in a current trend or correction, and then that helps me structure the trades in the Trading Nation appropriately. So the model we're following here is, as I mentioned, a triangle. And traditionally, a triangle is going to occur in the middle of a trend. So it's going to be something like this: up, down, a big breakout. And then usually after a big breakout wave, we go into a series of consolidation. Higher lows, lower highs, market kind of catching its breath before we move on up. This is the pattern I'm referring to. Typically in a sideways consolidation, which if you've ever looked at a chart, you've seen this before. Looking at the Elliott wave theory, it tells us that we can often suggest 5 swing waves within that triangle. So down in A, B, C, D. I think right now in the S&P 500, we're right there. I think we have one more drop down to go here, which gives us opportunities to be short before the market gathers itself, and then we continue on higher up towards new highs. So again, we're looking to play just this little move down here. Now, as we get off the model and go to real life, it should be very clear now. That's the market we're looking at here. That's the pattern we're looking at. So we have A, B, C, D, and we're looking for one more push down there in the E wave. And let's just draw the highs on our triangle, draw the lows in the triangle. So it looks like we have one more push down. Market should be able to find some support and then move on up to new highs. Okay, so the trade we're looking to do here is just to take us down to about that $260 region in the SPY. Again, not the bottom falling out, just a short-term trade here in the nation. So heading over to the trade tab here, I'm going to take you out to the May weeklies that expire on May 2nd. We're going to be buying the 265s, puts, selling the 260 puts altogether. That's going to be a debit or a cost to our account of about 73 cents, depending on where you're filled on the trade. So if we hit to trade, I'm going to let that guy go. So we're going to be risking the premium that we just paid, which should be about 72 cents, depending where you get filled. So that's the max loss. If I'm right, the max gain will be that $5 spread we just did, subtract from the premium we just paid, which would be about $4.33 of potential profit. So essentially, you're risking 70 cents to make $4.30. And in real option terms, that's $70 to make $430. Option markets think that's a pretty unrealistic probability trade, but according to the model that we have, I think the odds are slightly better than what option markets expect. So we're going to look for slightly lower prices in the SPY. For CNBC's Trading Nation, I'm Todd Gordon. Good luck on that trade. Be sure to position size appropriate here to hedge the portfolio that you need to hedge, or if you want to take an outright short position, be sure to realize that you could lose that $70 of premium that you're going to put out there, so position size accordingly. Be sure to follow us at Trading Nation on Twitter for updates to all the trades and markets that our traders are watching, and we'll see you guys in the next video update.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.